Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money maze. Today we're dissecting Solitron Devices Incorporated's latest quarterly report, and let's just say they've had a season of changes, maybe even a bit of a roller coaster. Strap in. So, Solitron Devices Incorporated is filing its quarterly report, a 10Q for the period ending the 31st of August 2025. This document gives us a peek into how the company is doing financially and operationally during that specific 3-month window. It is like looking at a snapshot of their business health. We'll be diving into their financial statements to see where their money is coming from, where it is going, and what that might mean for their future. Let us kick things off with a look at their balance sheet as of the 31st of August 2025 and compare it to the 28th of February 2025. Think of this as a company S financial snapshot at two different points in time. On the asset side, meaning what the company owns, their cash and cash equivalents have decreased from about $4.1 million to $2.85 million. That is a notable drop. Their marketable securities, which are like short-term investments, also saw a decrease from around $919,000 to $595,000. Inventories, what they have on hand to sell, went from about $3.4 million down to $3.3 million. A slight dip. Now looking at what they owe, their liabilities accounts payable, which is what they owe to their suppliers, have almost doubled from about $439,000 to $811,000. Customer deposits have also surged from $118,000 to $545,000, which could mean they receiving more prepayments from customers. On the flip side, accrued contingent consideration, which is payment tied to future events, has gone down. When we look at the equity side, the part that truly belongs to the owners, we see the common stock and additional paid. In capital have increased slightly. However, their retained earnings, which represent accumulated profits, have decreased from about $17.4 million to $16.87 million. This indicates that the company has either made less profit or incurred losses that have reduced their overall accumulated earnings. Now let us move to the income statement, the statement of operations, to see how they've performed over the last few months. For the 3 months ending the 31st of August 2025, net sales increased to about $3.98 million from $3.58 million in 2024. That is a good sign. Sales are up. But then we look at the cost of sales, which is what it cost them to make those products, and that also increased. This resulted in a gross profit of $835,000 for 2025, up from $738,000 in 2024. So they're remaking more on each sale, which is positive. However, their selling, general, and administrative expenses, which are things like marketing, salaries, and office costs, jumped significantly from $688,000 to over $1.1 million. This is a big jump, and it is eating into their profits. As a result, they went from an operating income of $50,000 in 2024 to an operating loss of $291,000 in 2025. So despite higher sales, they are now losing money on their core operations. This is partly explained by stock-based compensation, a cost related to stock awards, and options given to management and directors. Overall, their net income for the quarter turned into a net loss of $234,000 in 2025, compared to a small profit of $17,000 in 2024. The earnings per S-hair picture is also not great, going from a positive 0.01 to a negative 0.11. Looking at the 6-month period, the story is even more pronounced. Net sales actually decreased from $7.54 million in 2024 to $6.68 million in 2025. That is a significant drop of about 11%. The cost of sales went up, leading to a much lower gross profit. Gross profit for the 6 months dropped dramatically from $2.41 million to $1.22 million. And when you look at it as a percentage of sales, it went from a healthy 32% down to a much thinner 18%. This means for every dollar of sales, they're keeping a lot less profit now compared to last year, mainly due to higher material costs. Their selling, general, and administrative expenses also rose, leading to a substantial operating loss of $669,000 for the first 6 months of 2025, compared to a strong operating profit of $842,000 in the same period of 2024. And this translates to a net loss of $570,000 for the first half of 2025, quite a shift from the $606,000 profit they had in 2024. Their earnings per S-Hair also went from a positive 0.29 down to a negative 0.27, which is a significant downturn. Let's look at the cash flow statement, which shows how cash moved in and out of the company. For the 6 months ending the 31st of August 2025, they had $777,000 in cash from operations. This is positive, meaning their day-to-day business activities generated cash. However, this was boosted by several factors, including a recent increase in customer deposits and accounts payable, essentially juggling what they owe and what they've received. Where they spent a lot of money was in investing activities. They used $1.88 million for investing, largely due to purchasing a long-term investment of $1.65 million and paying for acquisition, related contingent consideration. This means they re-putting money into assets they expect to hold for a while, and also spending on deals they made. Financing activities show cash from borrowing or issuing stock, and cash used to pay back debt or buy back stock. For the 6 months ending the 31st of August 2025, they used $139,000, mainly for mortgage payments and repurchasing their own stock. This indicates they are managing their debt and also returning some capital to shareholders. Now, a quick check on their accounting policies just to understand their approach. They are preparing these statements according to generally accepted accounting principles, or GAAP, as they always should. They also mention that their estimates and assumptions can affect reported numbers, which is standard. They've been investing in marketable securities, mostly common stocks. As of the 31st of August 2025, their investments had a fair value of around $595,000, with unrealized gains meaning on paper they made money off about $65,000. This is part of their strategy to diversify. They use a 3-level system to measure fair value, with level 1 being the most reliable because it uses quoted prices for identical assets. Most of their common stocks fall into level 1. Their long-term investment, however, is in level 3, meaning it is based on unobservable inputs, which makes it a bit more subjective. There is also contingent consideration, which is essentially potential future payments tied to certain events, like performance targets from their acquisition of Microengineering Inc. This is recorded as a liability. On the 31st of August 2025, it was valued at $871,000, down from $1.23 million at the start of the year. This reduction suggests some of those earn-out targets might have been met or adjusted. Let's talk about where their sales are coming from. For the 3 months ending the 31st of August 2025, most of their sales, about $3.86 million, came from the United States, showing a strong domestic focus. Europe and Australia saw a significant increase in sales for this quarter compared to last year. Looking at their major customers, Linvatec and RTX Raytheon are still their biggest clients, making up a significant chunk of their revenue. For the 3 months ending the 31st of August 2025, Linvatec accounted for 40% of their sales and RTX Raytheon for 25%. L3Harris is also a notable customer. This concentration with a few large customers is a key risk area. On the supplier side, they rely on a couple of key suppliers for their production materials. For the 6 months ending the 31st of August 2025, 2 suppliers together provided about 49% of their materials, with one being particularly dominant at 39%. This reliance on a few suppliers is another area to watch. Now, a quick look at other important information. Under risk factors, they reiterate what we already know. They are heavily reliant on government contracts, which are subject to a lot of uncertainties like termination and price changes. Customer concentration risk is a big one, meaning if they lose one of their major clients, it could really hurt them. They also mentioned that changing defense priorities could impact their business, which makes sense given their customer base. They've been repurchasing their own stock. For the quarter ending the 31st of August 2025, they bought back about 3,850 shares, spending about $63,000. This is part of a larger program to buy back up to $2 million worth of stock. It can sometimes signal that management believes the stock is undervalued, or it can be a way to return value to shareholders. And speaking of stock, on the 13th of August 2025, they approved stock grants totaling 14,000 shares to executives and directors. The CEO, Colorado, OCFO, and board members all received grants. The fair value of these grants was substantial, over $225,000. This indicates that they are using equity to compensate and incentivize key personnel. Finally, the report is signed by the Chief Executive Officer, Tim Erickson, and the Chief Financial Officer, Carolyn Campbell, certifying that the information provided is accurate to the best of their knowledge. So, what is the verdict on Solitron Devices Incorporated? They're a company that is clearly navigating a complex market, especially with their heavy reliance on defense contracts. Their sales saw a decent uptick in the short term, but the longer term picture shows a decrease in revenue and a significant increase in operating expenses, which has led to a considerable operating loss and a net loss. This is really eating into their retained earnings. Their heavy reliance on a few major customers and suppliers presents a significant risk. While they did make a substantial investment in a long-term asset and seem to be managing their debt, the drop in profitability is concerning. They are also using stock-based compensation quite heavily, which is a cost that impacts their bottom line. It looks like they're trying to make strategic moves, like that long-term investment, but the core business is facing some real headwinds. I'd say Solitron is in a period of significant challenge. The increase in expenses and the resulting losses outweigh the positive sales growth in the short term. Investors should watch closely how they manage their costs, and if they can secure more diversified revenue streams or new growth opportunities. For now, it's a mixed bag with concerning profitability trends. What do you think about Solitron's financial health and their future outlook based on this report? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more in-depth corporate analysis. And don't forget to join our Discord community linked in the video description for more discussions. Thanks for watching, and I'll see you in the next one.